Right now, as you're watching this video, there's a 7-year-old girl in Michigan who's been denied a bank account. Not because she's too young, because she has too much debt. $43,000 in debt, 3 credit cards maxed out, an auto loan in default. A collection agency is calling her parents' house. She's never owned a credit card. She's in 2nd grade. Her identity was stolen the day she was born, and nobody knew until yesterday. If you have kids, check their credit tonight. I'm dead serious. Because what I'm about to show you will change how you think about identity theft forever. Picture this: a 9-year-old child in Wisconsin. Clean credit, no bank accounts, no social media. Just a kid living their life. Now imagine that same child's social security number is simultaneously building a credit score in Florida, opening credit cards in Texas, and taking out loans in California. The child has no idea. Their parents have no idea. And it won't be discovered for nearly a decade. This isn't science fiction. This is synthetic identity fraud, and it's the fastest growing financial crime in America. In 2023 alone, it cost lenders over $6 billion. But here's what keeps me up at night. That number only represents what we've detected. The true scale? We have no idea. Today, we're diving deep into a crime so sophisticated that traditional fraud detection systems can't see it. So patient that criminals wait years before cashing in. And so devastating that its victims often don't discover they've been targeted until they apply for their first job, their first apartment, or their first credit card. Welcome to the invisible epidemic that's rewriting the rules of identity theft. Let me tell you about Sarah Mitchell. Except Sarah Mitchell doesn't exist, never has, never will. But Sarah has a credit score of 720. She has 3 credit cards, all paid on time. She's been employed at a mid-sized marketing firm for 2 years. She has a checking account with a regional bank. Her LinkedIn profile shows a modest but believable career progression. Her social media presence is perfectly mundane: weekend brunches, motivational quotes, the occasional vacation photo. Sarah Mitchell is what criminals call a synthetic identity, and she represents the evolution of fraud. Traditional identity theft is brutally simple: steal someone's entire identity, max out their credit, disappear. The victim discovers the fraud within weeks, maybe months. Banks shut it down. Credit bureaus flag it. Law enforcement investigates. It's messy, traceable, and relatively short-lived. Synthetic identity fraud is different. It's patient, strategic, almost elegant in its deception. Here's how it works. Criminals start with a real social security number, usually belonging to a child, an elderly person, or someone who recently passed away. They pair that number with a fake name, a fake birth date, and a fake address. Then they apply for credit. They get rejected. Of course they do. No credit history exists for this fabricated person. But here's the crucial part. That rejection creates a credit file. The bureaus now have a record of Sarah Mitchell attempting to get credit. She exists in the system. Now the criminals wait. They might add Sarah as an authorized user on another synthetic identity's credit card. They open a secured credit card in her name with a small deposit. They build her profile slowly, methodically. They pay bills on time. They keep balances low. They make Sarah look like a responsible, boring, perfectly average consumer. 2 years pass. 3 years. Sarah's credit score climbs. 650. 680. 700. And then they strike. Credit cards, auto loans, personal loans. They max out everything simultaneously and vanish. By the time the fraud is discovered, the trail is ice cold and the losses are catastrophic. Here's what makes synthetic identity fraud so insidious. The victims often don't know they're victims. Let's talk about the children. Criminals love children's social security numbers because they're pristine. No credit history, no monitoring, no one's checking. A child won't apply for credit for a decade or more, giving fraudsters an enormous window to operate. There are documented cases of parents discovering their 7-year-old has been denied a student savings account because their credit report shows $50,000 in defaulted debt. Imagine explaining to your child that their financial future was stolen before they even learned to ride a bike. The elderly are targets too, particularly those in nursing homes or assisted living facilities. Their information is easier to access, and they're less likely to be monitoring their credit actively. By the time the fraud surfaces, the victim may have passed away, making prosecution nearly impossible. But here's the truly disturbing part. Sometimes there is no victim. Not in the traditional sense. Criminals are now generating completely fabricated social security numbers that pass initial validation checks. They're creating identities that don't belong to anyone. These ghost identities exist purely in the financial system, engineered from scratch for the sole purpose of fraud. When these schemes collapse, who's the victim? The child whose number was stolen? The banks that extended credit? The other consumers who pay higher interest rates to cover these losses? All of us? The answer is yes, all of us. Let me walk you through a real case that was prosecuted in 2022. Names have been changed, but the details are accurate. A criminal network in Southern California created over 1,200 synthetic identities over a 5-year period. They had a warehouse operation, literally a warehouse. Inside, they had a sophisticated setup: computers, printers, laminating machines for fake IDs, and a database tracking each synthetic identity's development stage. They categorized their identities into tiers. Tier 1. Seedlings. Newly created identities just entering the credit system. These were nurtured slowly. Minimal activity. Building credit files. Tier 2. Growers. Identities with 12 to 24 months of history. These received secured credit cards, small loans, authorized user status on other accounts. They were being cultivated, scores climbing into the 600s. Tier 3. Harvesters. Identities with 650 plus credit scores and at least 2 years of positive history. These were ready for the big play. Multiple credit cards, auto loans, lines of credit. Maximum extraction before bust out. The operation was staggeringly organized. They had spreadsheets tracking payment due dates to keep accounts in good standing. They had money mules, often unwitting participants who thought they were working legitimate jobs, receiving packages and forwarding them to other addresses. They had individuals working part-time at car dealerships and retail stores, providing inside access to facilitate fraudulent applications. They employed people full-time to maintain the social media profiles and LinkedIn accounts of these synthetic identities. Real posts. Real engagement. Some of these fake people had more online friends than actual humans. The sophistication didn't stop there. They rented mail drops under the synthetic identities. They had burner phones with voicemail set up in case creditors called. They created email addresses and let them age, building digital footprints that looked legitimate. When they finally executed their bust-out, they did it across all 1,200 identities simultaneously over a 72-hour period. They obtained over $40 million in fraudulent credit. By the time financial institutions realized what happened, the money had been converted to cryptocurrency, gift cards, and high-value goods that were resold. The recovery rate was less than 3%. The criminal network? They were eventually caught, but only because a data analyst at a credit bureau noticed an unusual pattern. Multiple credit inquiries for different individuals, all coming from the same IP address at a car dealership. One small mistake in an otherwise nearly perfect operation. This wasn't a one-off. Operations like this exist right now, running quietly in the background of our financial system. You might be wondering, why can't banks detect this? They have fraud detection systems, artificial intelligence, billions of dollars in security infrastructure. The brutal truth? Synthetic identity fraud is designed to be invisible to traditional fraud detection. Think about how banks typically catch fraud. They look for anomalies, sudden spending spikes, unusual locations, deviations from established patterns. But synthetic identities don't deviate from patterns because they are the pattern. From day one, they're designed to look normal. A real identity theft victim has a legitimate credit history that suddenly goes haywire. Red flags everywhere. A synthetic identity. It's built to look like a real person responsibly using credit. Every transaction is calculated to appear legitimate. Credit bureaus face a unique problem. When a new credit application comes in, they match it against existing records. If there's no match, they create a new file. They have no way to verify that the person actually exists, only that the information is internally consistent. Here's the really problematic part. Credit bureaus don't communicate perfectly with each other. A synthetic identity might exist at Experian, but not TransUnion. Or the information might be slightly different across bureaus, making it even harder to detect the fraud. Banks also face a perverse incentive. These synthetic identities often make payments for years before the bust-out. They're profitable customers right up until they're not. Some financial institutions have been criticised for not investigating suspicious patterns because those accounts were generating revenue. And there's another layer, the sheer volume. Banks process millions of applications. They need automated systems. Those systems are optimised for efficiency and customer experience. Add too much friction, and legitimate customers go elsewhere. It's a balancing act, and fraudsters exploit that balance ruthlessly. Even when synthetic fraud is detected, prosecution is complicated. Traditional identity theft has a clear victim who can testify. With synthetic identities, especially those using fabricated social security numbers, who's the victim? It's a financial loss to institutions, but criminal cases require individual victims. Prosecutors often struggle to build cases. The result? Synthetic identity fraud has an estimated prosecution rate of less than 5%. Criminals know this. The risk-reward calculation is heavily in their favour. Let's bring this back to earth. What does this actually mean for regular people? First, if you're a parent, there's a non-zero chance your child's social security number is being used right now. The Federal Trade Commission estimates that over 1 million children are victims of identity fraud annually, and a significant portion is synthetic fraud. Here's a gut-wrenching story. A family in Arizona discovered their 11-year-old daughter had a credit report showing $89,000 in debt. Multiple credit cards, an auto loan, even a mortgage application. The parents had been diligent, checking their own credit regularly, filing their taxes, monitoring their bank accounts. But they never thought to check their children's credit. Why would they? When they discovered it, they spent 18 months fighting to clear it. 18 months of paperwork, police reports, affidavits, disputes with credit bureaus. Their daughter missed out on a scholarship program that required a background check which flagged the credit issues. She was 12 years old. For adults who discover their information has been used in a synthetic scheme, the cleanup is a nightmare. Unlike traditional identity theft, where fraudulent accounts can be disputed and removed, synthetic identity fraud creates a grey area. The accounts exist in a kind of legal limbo. They're not entirely yours, but they're tied to your social security number. Untangling that mess can take years. And then there's the economic impact on everyone. These losses don't just disappear. Banks pass them on through higher interest rates, increased fees, stricter lending criteria. That startup that couldn't get funding, that family that was denied a mortgage, that student who was rejected for a loan. Some percentage of those denials exists because institutions are tightening standards in response to synthetic fraud losses. Small businesses suffer too. They're often targeted for bust-out schemes, particularly auto dealerships and electronics retailers. A small dealership that gets hit with multiple synthetic identity frauds can face financial ruin. Insurance doesn't always cover these losses because the dealership technically approved the transaction. So what's being done? The financial industry is fighting back, but it's an arms race. As defenses improve, so do the criminals' tactics. Some banks are implementing consortium data. Essentially, they're they're sharing information about application patterns across institutions. If the same synthetic identity applies at multiple banks in a short period, it raises flags. But this requires cooperation among competitors, which is complicated by privacy laws and business interests. Biometric verification is being explored, requiring a photo, a fingerprint, or a video selfie during account opening makes it harder to create fictional people. But it also creates privacy concerns and adds friction to the customer experience. The Social Security Administration has been urged to change how Social Security numbers function. Make them dynamic, add verification layers, create a way for individuals to lock their number like you can freeze your credit. But the SSA is a massive bureaucracy managing 333 million numbers. Change is slow. Some states have passed laws allowing parents to freeze their children's credit, creating a credit file that blocks new accounts from being opened. It's a good step, but it's not universal, and most parents don't know it's an option. Financial institutions are also using more sophisticated AI to detect synthetic fraud, looking for subtle patterns. Multiple applications with similar typing speeds or patterns suggesting the same person is behind different identities. IP address analysis, device fingerprinting, behavioral biometrics. But here's the problem. Criminals are using AI too. They're generating more realistic fake social media histories. They're using deepfake technology to create photos for fake IDs. They're employing machine learning to understand what patterns banks look for and designing their schemes to avoid them. One security researcher I spoke with put it bluntly, "We're teaching an AI to catch fraud, and the fraudsters are teaching their AI to beat our AI. It's an endless cycle." So what can you actually do? First, freeze your child's credit. Seriously. Do it today. Contact all 3 credit bureaus, Equifax, Experian, and TransUnion. Provide proof of your child's identity and yours and freeze their credit. It's free. It takes about an hour total, and it could save your child from a nightmare. Second, monitor your own credit religiously. Not just your accounts, your actual credit reports. You're entitled to free reports from all 3 bureaus. Stagger them throughout the year. Check every 4 months. Look for accounts you don't recognize, inquiries you didn't authorize, addresses that aren't yours. Third, be extremely protective of your Social Security number. Don't carry your card in your wallet. Don't give the number out unless absolutely necessary. If someone asks for it, ask why they need it and if there's an alternative identifier you can use. Fourth, set up alerts on all your financial accounts. Every transaction, every login. Yes, it's annoying, but you'll know immediately if something's wrong. Fifth, if you have elderly parents or relatives, help them monitor their credit too. Fraudsters target those least likely to notice. And if you discover you're a victim, act immediately. File a police report. Contact the credit bureaus. Submit identity theft affidavits. Document everything. It's a long process, but the sooner you start, the less damage will occur. Here's something most people don't know. You can request a free credit report for your child at any time if you suspect fraud. You don't have to wait until they're 18. If there's a credit file in your child's name when there shouldn't be, that's your first red flag. Synthetic identity fraud represents something deeper than just financial crime. It's a symptom of how disconnected our identity infrastructure has become from reality. We're using a social security system designed in 1936 as the backbone of identity verification in 2025. We're relying on credit bureaus that create files based on trust, not verification. We've built a financial system that values speed and efficiency over security. And real people are paying the price. Children losing their financial futures before they even understand what money is. Families spending years fighting to prove a negative, to prove someone doesn't exist. Banks losing billions, which they pass on to all of us. The criminals behind synthetic identity fraud aren't the stereotypical hackers in hoodies. They're organized networks running sophisticated operations. They're patient, strategic, and they're winning. But awareness is power. Every parent who freezes their child's credit is one less easy target. Every person monitoring their credit report is one more set of eyes catching fraud early. Every small business that adds verification steps is one more barrier in the fraudster's path. This isn't going away. If anything, as AI makes it easier to create convincing fake identities, the problem will get worse before it gets better. But if we understand how it works, if we protect ourselves and our families, if we demand better systems from the institutions we trust with our financial lives, we can fight back. Sarah Mitchell, that synthetic identity I told you about at the beginning, she's still out there. Maybe under a different name now. Maybe with a different social security number. But she's building credit, looking legitimate, waiting for the right moment to strike. The question is, will we let her? Thanks for watching. If this video opened your eyes to synthetic identity fraud, share it with someone who needs to see it, especially if they're a parent. The more people who understand this threat, the harder we make it for fraudsters to succeed. Drop a comment below telling me if you've checked your child's credit or if you've had any experiences with identity fraud. I read every comment, and your stories help others understand the real impact of these crimes. Hit that subscribe button if you want more deep dives into the financial crimes hiding in plain sight. Next week, we're exploring romance scams and the psychology criminals use to steal millions from vulnerable people. Stay vigilant out there.